So what do you want to know about retirement tax planning? Well, when we're talking about our retirement nest egg, oftentimes we're talking about those retirement accounts, right? We're talking about 401ks, 403bs, IRAs, 457 plans, wherever you have retirement assets in traditional retirement accounts. These are tax deferred accounts. Okay, what that means is that these tax deferred accounts you've contributed to throughout your career, but you haven't paid taxes on the contributions yet. See, the IRS lets you make all those contributions to those tax deferred accounts, so they haven't collected their tax revenue on it. Well, come retirement, when you're starting to withdraw from your nest egg, all the money that you withdraw from those tax deferred accounts are going to be now taxed, and they're going to be taxed as income. Okay, fair enough. That's a good enough deal. However, if you're not drawing enough from those tax deferred accounts, the IRS is once again going to step in, and they're going to say, hey, we don't want you passing all these assets on to the next generation. We don't think that you're taking enough from these accounts throughout your lifetime. So starting at age 73, we are going to force you to take a minimum amount from these accounts so that we are starting to collect all that tax revenue that we want on these accounts. Okay. So what ends up happening? Well, now more than ever, in today's day and age, most people have built up pretty substantial amounts within these tax deferred accounts, their 401ks, their IRAs, their 403bs. So now they're dealing with substantial account values that now the IRS is saying you have to take a minimum amount from that account each year. And it might start off as only $30,000, right? At age 73, it might start off as only $30,000. And you say, hey, that's no problem. I was going to take that this year anyways. I'm reaching that minimum, no problem. But then you get to age 75, and then it's like $50,000. And then you get to age 80, and it's $100,000, and so on and so forth. And all of a sudden, you're getting into the later years of retirement, and you're being forced to take income that you may not want or need, and it's forcing you into higher tax brackets. That's the scenario that we'll often see in terms of required minimum distributions. And it's unfortunate because, like I said, this is income that you might not want or need, but now you're being taxed at a higher rate. You're paying more taxes for income that you don't want. So for our dear, dear friends, Jack and Diane, this is exactly what happens. This is what's projected to happen to Jack and Diane, right? Because in the early years of retirement, they're only taking about $50,000 in income from their retirement nest egg. And based on their withdrawals and based on their portfolio growth, once they hit age 73, those required minimum distributions are going to kick in, and that's going to kick them up into substantially higher tax brackets. And that's where they're going to remain for the rest of their retirement. They're going to be stuck having to take income they don't want or need and paying much higher taxes on it. So what do we do about this? What can we do to offset this? This gets to the core of retirement tax planning. We can introduce what is known as a Roth conversion strategy. Here's why Roth accounts are the most powerful wealth accumulation tool that we have at our disposal. When it comes to Roth accounts, Roth IRAs, we put post-tax dollars into these accounts. So this is money that has already been taxed that goes into these Roth accounts. Because it's already been taxed, it is now tax-free. It's an investment account that can grow tax-free for the rest of your life, not subject to income taxes, capital gains taxes, or required minimum distributions. Most powerful wealth building tool that we have at our disposal. So what do we do in Jack and Diane's situation? Well, we know that they're in the 12% tax bracket right now, right? That's a favorable tax bracket relative to where they're headed once RMDs kick in. So what do we do? Well, we can strategically take a little bit more at the end of each year from their tax-deferred nest egg, pay the taxes on it, and convert that money into a Roth, where it's then going to grow in terms of investment value. And if they want to withdraw it years down the line, it's going to be tax-free. So what have we done? We're paying taxes on income at a favorable rate today. So we're going to pay taxes on that extra withdrawal that we're going to convert to a Roth. Maybe it's $10,000 this year. Maybe it's 20, maybe it's $30,000 this year. Whatever's going to keep us in that favorable tax bracket, we're going to take that amount, a one-off withdrawal at the end of the year. We're going to convert it into a Roth, get that money invested, and let it grow tax-free for the rest of their life. So now we've created tax savings. By not deferring that tax, we're paying the taxes on it now at a much more favorable rate. So each and every year, we're going to generate substantial tax savings. And we're also going to reduce our RMD amounts. We're going to reduce the required minimum distributions that are coming down the road. So what does this look like in practice? Well, as you can see, that green bar represents additional withdrawals from their tax-deferred accounts. That green bar represents Roth conversions to fill up that favorable tax bracket and pay the taxes now, get it into a Roth. And what it ends up doing is saving Jack and Diane $188,000 in tax savings throughout the course of their retirement. Just by taking an extra $10,000 this year, $20,000 this year, whatever it might be, calculating what's going to keep you within that favorable tax bracket, withdraw it, pay the taxes on it, convert it into a Roth. It's easy. Just takes a little bit of analysis, but this is a situation that tends to be the single greatest value generator for retirees with substantial savings saved up in their tax deferred account, right? This is 100% worth exploring if you happen to be one of those people that has substantial savings across you and a spouse in tax deferred accounts, because the RMDs are unavoidable unless you start taking Roth conversions, paying the taxes at a favorable rate, create massive savings each and every year.